The market just told you exactly what it believes. The AI building boom is now the engine of the whole economy. That same boom is pushing prices higher, and it has the Federal Reserve leaning toward raising interest rates rather than cutting them. This is your weekly market and value aligned portfolio review for July 11, 2026. Over the next few minutes, I'll show you what moved, why it moved, and what it means for the companies you own right before the biggest earnings week of the year. If we haven't met, I'm Burke's AI avatar. I deliver financial content for free, so you don't have to pay. Burke reads every comment and writes every lesson. Here's the path. We start with the US indexes, the sectors, and the week's biggest winners and losers. Then the Fed, the economy, oil, and how AI ties it all together. We finish with next week's earnings bar and a full look at your portfolio. Let's start with the 4 funds people watch to judge US stocks. Each one is an ETF, which is just a basket of many stocks you can buy like a single share. SBuy holds the 500 largest US companies, weighted by size, so the biggest names count the most. RSP owns those same 500 in equal slices, so a small company counts as much as a giant. QQQ tracks the 100 biggest tech-heavy names. IWM covers small companies. This week, the giants won. SBuy rose 1.4% and QQQ rose 1.8%. The equal weight fund slipped 0.3%, and small caps fell about 0.5%. Only 42 out of every 100 companies in the S&P 500 closed higher on Friday. Money crowded back into a small group of huge AI names. One thing before you decide, the rally is too narrow. For the year so far, equal weight is up 12.7% and small caps up 20.7%, both ahead of the 11.3% from the big company index. YTD just means year to date or how much it has gained since January. Now the sectors. A sector is a group of companies in the same line of business, like energy or healthcare. Energy led the week, up 3.5% after oil prices jumped. I'll explain why oil moved in a minute. Technology came next, up 2.9%, riding the AI wave. At the bottom, materials fell 2.2% and healthcare fell 1.8%. Home builders and defense stocks were the weakest groups of all. The pattern is simple. Anything tied to AI or oil went up. Anything tied to interest rates or slow, steady demand went down. Here are the 5 biggest winners in the S&P 500. Every single one is an AI story. HPE, short for Hewlett Packard Enterprise, sells the servers that run AI, and it jumped almost 18%. Arista makes the fast switches that connect AI computers inside a data center. Meta, the company behind Facebook, said it will now rent out its computing power to other businesses. Akamai works on AI security, and Seagate makes the hard drives that store all the data AI needs. It is up 231% this year. When the same theme wins 5 times in 1 week, the market is showing you where it sees growth. The losers tell 3 separate stories. Moderna, the vaccine maker, gave back part of a big run-up from the month before. Builders First Source sells lumber and parts to home builders, and it fell because higher mortgage rates are freezing the housing market. Paramount Skydance dropped after an analyst warned about its heavy debt from a merger. Alexandria owned science labs and slid as its rent income shrank. Intel fell mostly because other chip stocks sold off that day, not because of its own news. A stock can drop for reasons unrelated to the business itself. Keep that in mind when you see red. Now, the most important document of the week. Every 6 weeks, the Federal Reserve, our country's central bank, meets to set interest rates. A few days later, it releases the minutes, which are the written notes of that meeting. These notes were hawkish. Hawkish means leaning toward higher interest rates to fight rising prices. Inflation, the rate at which prices rise, is running near 4%. That is about twice the Fed's 2% goal. Core inflation, which excludes food and gas to show a steadier trend, sits at 3.4%. Here is the part that caught my eye. The word AI appeared 21 times in these notes, up from 8 times in April. The Fed now thinks the AI building boom is adding to inflation, By Friday, traders saw a 64% chance the Fed raises rates in September. The economy looks weak on the surface and strong underneath. GDP measures everything the country produces. One popular tracker put growth at just 1.3%. That low number is misleading. The drag came from imports. When we buy AI equipment from other countries, it subtracts from the GDP math, even though that spending is a sign of strength. Strip it out, and real private demand, the cleaner measure of what people and businesses actually bought, is running near 2.9%. Business fixed investment, which is money companies spend on equipment and buildings, grew 8.2%. The country bought a record $128 billion of AI gear in a single month. The headline says slow, the details say strong. Oil jumped this week for one clear reason. A ceasefire between the US and Iran fell apart on Wednesday. WTI and Brent are simply the two main types of crude oil the world prices off. WTI rose about 4% to $71 a barrel. The bigger worry is the Strait of Hormuz, a narrow stretch of water where a large share of the world's oil ships through. Traffic there slowed to almost nothing. When that path is blocked, oil gets tighter and prices rise. One quiet detail matters for us. Gold actually fell this week, even with fighting in the Gulf. That tells you the market's fear is inflation, not a crash. Let's tie the week together with one picture. Think of the AI building boom as a single engine turning one big gear. That gear spins four smaller ones. The boom floods the country with imported equipment, which distorts the GDP number. Inflation climbs toward 4%, which makes the Fed lean hawkish. The neutral interest rate rises, meaning the resting level for rates in a healthy economy moves up. And chip, networking, and storage stocks shoot to the top of the market. The economy and the market are being pulled by the same engine. Earnings season starts Tuesday. Earnings are the profits companies report every 3 months. Right now, the bar is high. FactSet, a research firm, expects S&P 500 profits to grow almost 24% from a year ago. If companies beat expectations the way they usually do, real growth could top 29%. Tech profits alone may grow 48%. One money manager, Bruce Zarrow, put it plainly. He said he would not expect big moves in tech stocks unless they beat by a wide mile. When hopes are this high, simply meeting them may not be enough to move a stock up. Now your portfolio. The AI names did the heavy lifting. Broadcom rose 11% after it widened a deal with Apple through 2031 and showed off a new custom chip built with OpenAI. NVIDIA, which makes the main AI chips, gained about 8%. AMD, another chip maker, rose almost 8% and is your biggest winner this year, up 160%. Diamondback Energy climbed with oil. Tesla rose after a record quarter of car deliveries. I was working with a client recently who wanted to sell the energy position because oil had been quiet for months. This week is the reason we hold it. Diamondback is the built-in hedge for exactly the kind of oil shock we just saw, and it did its job. Here are the 5 that lagged, and I'll name them honestly. Copart, which runs online car auctions, hit a new low after news that its CEO is stepping down. Home Depot fell because the frozen housing market means fewer projects. Kinsale, a specialty insurer, drifted lower with no real news. Medpace, which runs medical trials for drug companies, fell after 2 analysts cut their ratings on price. AutoZone dropped on a rumor that a rival might buy another parts company. Not one of these 5 had a broken business. A CEO change, a slow housing market, a quiet week, 2 rating cuts, and a rumor. That is noise, not damage. I had a client last month ask if the Home Depot drop meant something was wrong with the company. Nothing was wrong with it. Buyers are simply waiting for mortgage rates to come down, and the demand builds up the longer they wait. Here is what to watch next week. A catalyst is an event that can move the market. Tuesday brings the June CPI report, the main measure of inflation, plus earnings from the big banks. Wednesday brings PPI, which tracks prices at the wholesale level before goods reach store shelves. Thursday is the one I care about most for your portfolio. TSMC reports. TSMC is the factory that makes the chips for Broadcom, AMD, and NVIDIA, and it is a 5.3% position for us. What it says about demand will move all three. Friday brings housing and factory data. Two numbers matter than any headline in between: Tuesday's inflation report and Thursday's TSMC result. Three things matter most as we head into the week. First, the economy is stronger than that 1.3% headline, so build no case on rate cuts coming soon. Second, the profit bar is above 22% growth, so expect money to rotate between sectors rather than a broad drop. Rotation just means money moving from one group of stocks to another while staying invested. Third, your portfolio owns both sides of the AI story: the companies building the equipment and the steady businesses whose only problem right now is interest rates, not a broken model. Watch Tuesday's inflation report and Thursday's TSMC results more closely than any headline in between. Let the earnings, not the futures market, tell you which businesses are actually growing. Owners of great companies get paid for patience in stretches like this.